Good evening, everyone, and welcome to this webinar by Yukthi. Yukthi, if you don't know, is a Debt Justice Network in Sri Lanka, and we host many webinars, face-to-face events. Most recently, we had an event in Kandy about the debt crisis in Sri Lanka, and about 7 international experts, including the former finance minister of Argentina, Martin Guzman, come to Sri Lanka, and we had 3 days of engagement. We recently had a webinar with Peter Doyle, who's a former IMF staff economist. So those are the sort of engagements that we normally organize. As all of you know, Sri Lanka is going through a severe economic crisis, and we are in an IMF program and a debt restructuring process. So these events and our engagement is to really shed more light on these processes. As all of you know, this is also a very important moment here in Sri Lanka with the presidential elections coming up on Saturday. So we've also organized this webinar to understand some of the issues that are being debated, including in the election campaigns, about questions relating to the IMF program and the debt restructuring process. Some questions that have emerged are, can Sri Lanka renegotiate the IMF agreement, what that would mean, and what would an alternate debt sustainability analysis look like? So we are really fortunate. We have 2 well-known experts today. First, we'll be listening to Brad Setzer, who's a senior fellow at the Council on Foreign Relations and former staff economist at the US Department of Treasury. And then we will also be listening to Malina Stutz, who's an economist and policy advisor at Jubilee, Germany, and also active with the European Debt Justice Movement, Eurodad. So I think the format today is going to be, we're going to have Brad go first. I'll put forward some questions to him, but really he can expand on them. And so we'll listen to Brad for about 15 to 20 minutes. And then that would be followed by some questions to Malina, and she would speak for about 10 minutes. And then there'll be time for all of you also to ask questions. You can raise your hand and either ask questions verbally, but please keep your questions short so that we can use the time as optimally as possible. Or you can also put questions in the chat and I will read them out to Brad and Malina. So we have, it's meant to be an hour-long program, so we have about 55 minutes left. So I'll get right to the point. I'll start with Brad. Brad, how do you see the sort of the problems in Sri Lanka in terms of the current debt sustainability framework that the IMF has put forward? In that program, they, I think, talk about the total debt, but not necessarily. Is that an issue? And another question, Sri Lanka has periodically gone into balance of payment problems, and I think it was this last major problem that led to this crisis. Do the IMF programs and the debt sustainability analysis take into consideration balance of payments? Or if not, how could we accommodate that? What should, say, the next Sri Lankan government be thinking about in relation to the IMF program and ensuring sort of sustainability of balance of payments? And a third question, Sri Lanka is in the middle of renegotiating, negotiating with the bondholders as well as the official creditors. The bondholder deal has not quite been finalized. But we hear of macro-linked bonds. In other words, if Sri Lanka's economy performs better, then we would be paying more in the form of interest to the bondholders. With the current debt restructuring process, does that make sense? Is that a fair process? So maybe those three questions, but feel free to also touch on other issues that might benefit our audience.
Thanks for the invitation to speak, and thanks for the very important set of questions. To start with what in the US we call the bottom line up front, the IMF's debt sustainability analysis for Sri Lanka allows, for better or for worse, Sri Lanka to have a rather substantial level of public debt. So the criteria is total debt, domestic fiscal debt, external public debt combined, very high level over the next 10 years. The binding constraint was set at 95% of GDP in 2032, which is, 8 years from now. And as a consequence of that, debt to GDP at the end of the IMF program in 2028 would be well above 100% of Sri Lanka's GDP. These are quite elevated levels for any low-income, lower-middle-income country, substantially higher levels than other countries that have gone through debt restructuring typically come out of a restructuring with. So the immediate question that was raised after the IMF put forward its debt sustainability analysis was more or less, why is Sri Lanka able to support this high level of public debt? What is the analytical basis for concluding that Sri Lanka can support more debt than, say, Zambia or, say, Ghana or Kenya or, for that matter, Pakistan? It's a substantially higher level of debt than is typical for countries of broadly similar income levels, countries that have had a history of occasionally accessing international bond markets, but not a history of consistently accessing international bond markets. And the conclusion I came to, more or less, was that there wasn't a strong analytic basis to conclude that Sri Lanka could support this high level of public debt and public external debt. Why? Well, Sri Lanka actually has a relatively weak revenue base. Revenue to GDP has often been 10% of GDP or less. It's been, on average, over the last 10 years, less than 12% of GDP. Obviously, the IMF program seeks to correct that, to raise revenues to GDP. But relative to its peers, Sri Lanka's revenue generating capacity in the past has been on the low side. And then Sri Lanka's export base also looks comparatively low, though not as low as its revenue base. Both call into question whether Sri Lanka can really support this higher level of debt. So I want to step back and ask, why and how did the IMF reach this conclusion? Because I think it is important. I think it's important for Sri Lanka above all, but it's also important for the international sovereign debt architecture. The IMF right now doesn't have one debt sustainability framework. It has two. It has one framework for low-income countries and another framework for market access countries. Sri Lanka is just a bit too wealthy, just a bit too high a per capita GDP to fall into the low-income country category. So Sri Lanka is basically one of the poorest countries that is evaluated on the market access country debt sustainability framework. The low-income country framework differs in a number of very, very significant ways from the market access debt sustainability framework. It is more rigid, for sure, allows much less scope for very high levels of debt to GDP. It also focuses primarily on variables related to a country's external debt, that is, debt owed to non-residents, debt owed to China, debt owed to the multilaterals, debt owed to the international bondholders. It doesn't focus as heavily on internal fiscal debt, debt owed to the domestic banks or the domestic pension funds. And for external debt, there are limits on the amount of external debt to GDP, on the amount of external debt relative to exports, on the amount of external debt service relative to revenues, and on the amounts of external debt service relative to exports. There's a final limit on overall debt relative to GDP, which is actually set at a quite low level, around 60% of GDP, which undeniably would have been a major complication for a country like Sri Lanka, which at times, depending on the precise level of GDP, has had domestic debt on its own close to that level. So it's no way would it be easy for Sri Lanka to fit into the low-income country debt sustainability framework. But it does set out relatively clear criteria. For example, external debt to GDP generally should be reduced to between 30 and 40% in a restructuring. External debt service relative to revenues should be around 18%. All of these would imply much more debt relief from external creditors than what Sri Lanka was required to seek under its own DSA. So the market access DSA, debt sustainability analysis, which is the relevant framework for Sri Lanka, uses a fundamentally different model. It's a model that was actually designed not to set targets for debt restructuring, but rather to help the IMF provide fiscal advice to countries with Sri Lanka's levels of income on up to the countries with the levels of income of the United States and Japan. So it is focused entirely, you might say, on fiscal variables, and the relevant debt concept is total public debt. External debt and external reserves simply don't enter in to this concept of debt sustainability. And in its medium-term assessment, the IMF concluded, and there's some value in simplicity, that essentially two variables matter. One is the gross financing need relative to the size of the domestic banking system. The gross financing need is the projected fiscal deficit plus the amount of debt that matures and comes due and has to be refinanced. The other variable is the slope of the projected path of debt to GDP. And the only real demand there is that that slope needs to be coming down. For countries like Sri Lanka that have had a crisis or in an IMF program that had a big devaluation several years ago, debt to GDP is almost always forecast to be on a downward trend. So that second variable didn't enter into the calculation. What did enter is the calculation of gross financing need relative to GDP. And the essential argument of the IMF's model is twofold. One, if you have a smaller gross financing need, less need to refinance, smaller fiscal deficits, you can support more debt to GDP. So the relatively low level of Sri Lanka's gross financing need pushed up estimates of Sri Lanka's debt carrying capacity. And the other component is that a big domestic banking system allows a country to support a higher level of debt to GDP. Domestic banks typically roll over domestic debts. They provide a buffer that can help countries absorb shocks. Both are reasonable, debatable propositions. They aren't variables. They're variables that one would normally actually want to consider. But they do seem to have some unusual effects. namely that as a country's domestic banking system increases in size, the overall amount of debt that a country is expected to be able to carry goes up. So because Sri Lanka had a large domestic banking system, the IMF concluded it could support a large amount of external debt. That is, I think, debatable. The other components of this analysis are what it omits. It omits debt to revenue, which has historically been a key issue for Sri Lanka, a very low level of revenue. Now, in general, less revenue means less capacity to support debt, whether domestic or external. And then it simply didn't set out independent limits on how much external debt Sri Lanka could take on relative to GDP or relative to exports. External debt was an omitted variable in the market access DSA. What was included was a separate limit on the gross financing need in foreign currency, which was set at 4.5% of Sri Lanka's GDP. This is significant for a couple of reasons. First reason is that if you look at this as a constraint on external debt service, which is what it became after Sri Lanka restructured domestic debts so that they're no longer denominated in foreign currency, it becomes a 4.5% of GDP constraint on external debt service. If you evaluate that constraint relative to the constraints that emerged on other low-income countries that have gone through recent restructurings, it allows substantially more external debt service than was allowed in other cases. In Zambia and in Ghana, the relevant variable was 18% of revenue, which works out to being roughly 3.6% of GDP. So to simplify a bit, and there's some variation, Zambia in the low baseline was a little below that, they have a constraint of 3.5% of GDP. Sri Lanka's constraint was 4.5% of GDP, which doesn't sound like a lot, but it allows substantially more scope to construct deals that are favorable to creditors. Also, because this is defined relative to GDP, the more GDP, and in particular dollar GDP, is forecast to go up, the more debt service that's available for private creditors. That was a critical component of the insights that led creditors and bondholders in particular to push for the macro-linked bonds. So to step back, Sri Lanka was judged under the market access debt sustainability framework, not the low-income country debt sustainability framework. Because of some technical features of the market access debt sustainability framework, Sri Lanka is allowed or projected to be able to carry substantially greater debt and pay substantially more debt service, particularly relative to its revenues, than would have been the case had Sri Lanka been judged on the low-income country debt sustainability framework. If you take the 18% of debt service criteria and you apply it to Sri Lanka's projected revenues of 15% of GDP, you actually come up with a debt service envelope that is about half of what Sri Lanka was allowed. And as a result, Sri Lanka, under the IMF's baseline, is projected to be able to return to the market and refinance quite substantial amounts of bond payments and presumably bilateral payments after 2028 at debt levels that are quite high, around 100% of GDP, debt levels at which Sri Lanka has no history of actually being able to sustain, or any evidence that Sri Lanka can borrow in the market at a reasonable rate at these levels. It's a known unknown, but it clearly is a program whose debt sustainability assumptions are on the generous side for creditors and thereby poses large risk for Sri Lanka. On the balance of payments side, it is the case that the program does have a buildup of reserves inside Sri Lanka that should provide a buffer against future distress. Most of those reserves are borrowed from the IMF, but nonetheless, Sri Lanka will emerge from the IMF program, if the IMF program's forecasts are correct, with more than $1 billion, like with a reasonable level of reserves. I forget whether it's 5 or 10 billion, which gives it a little bit of a buffer. It won't be on the edge of literally running out of foreign exchange. So that's positive. On the negative, because the program doesn't constrain external debt or external debt service that heavily, there will be substantial drains on those reserves tied to the refinancing of maturing bonds. And if you think that net external debt is an important variable, that is the total amount of external debt relative to your reserves, well, Sri Lanka, kind of entered into its IMF program with 40 billion of external debt. That's going to go up to 45 thanks to borrowing from the MDBs and IMF, and like 1 billion of reserves. If that's a pretty big gap, and you might argue that that would weigh against Sri Lanka's ability to support very high levels of external debt going forward. It's one thing to have 40% of GDP in external debt if you got 20% of GDP in reserves. It is another thing to have 40% of GDP in external debt if you've got 5% of GDP in reserves. Final point is on the macro-linked bonds. So I am not a fan of considering the macro-linked bonds to be a form of contingent instruments. They aren't really contingent. By that, I mean, after the size of the bonds is set in 2028, they don't change. If Sri Lanka has a horrible economic crisis in 2030, there is no bend in the bonds. Sri Lanka faces the debt service profile that emerges at the end of the IMF program. What creates the so-called macro linkage is that the amount of debt and amount of debt service on Sri Lanka's new international bonds is not actually set now at the point of time when there's a framework agreement with the bondholders. Rather, it sets in several years once Sri Lanka's GDP at the end of its program period is clearer. The baseline has Sri Lanka's average GDP over the next few years at around 90 billion, and under that baseline, Sri Lanka would be paying $1 billion, $1.1 billion in foreign currency external debt service on its bonds alone, and the bonds are only about a third of the external debt in 29, 2030, 2031, 2032. If GDP were to be above 100, that goes up to about 1.5, 1.6 billion dollars a year. So the increase is about 450 million. If Sri Lanka's GDP goes up by 10 billion on average. And then if Sri Lanka's GDP falls more like 85 billion, that would be below its current levels, the macro-linked bonds reset down, and Sri Lanka gets a 200 million break on its bond debt service payments over those years. So there is some downside protection for Sri Lanka. There's a lot more upside for the bondholders, and that may be an issue with the assessment of comparability of treatment. But to me, the basic concern is that in a context where overall debt levels in the baseline are actually quite elevated, extremely elevated, I would say, the macro-linked bonds provide an extra bonus to the bondholders. And so from a broader point of view, it doesn't seem to me that the bondholders have provided the kind of deep concessions that would normally be associated with these kinds of features. So I do have concerns. I have concerns about the overall level of debt. I have concerns about the level of external debt and the absence of constraints on external debt service that are more binding, and about the particular structure of the macro-linked bonds. Combine that, I do worry that Sri Lanka is being set up to encounter renewed financial trouble 5 years from now. Thank you.
Thank you very much, Brad. That was really useful analysis. Maybe I think for the participants here, Yadusha, if you can share Brad's recent article, it appeared in July on the Council of Foreign Relations, that might be useful in terms of to be able to process a lot of what Brad was saying. But before I go to Malina, just I think some of the things that Brad was saying to get a sense of the numbers. For example, while there would be 4.5% of GDP in external debt servicing after the IMF program is over, to give you a sense, the amount, the kind of target in terms of social protection for people in for the vulnerable people in Sri Lanka is only 0.6% of GDP. Just so that sometimes these numbers are hard to grasp if you don't follow them carefully. And I think maybe during the next round of questions to Brad, to also think about, I think what Brad is getting at is that we would exit the IMF program in 2028, and that's when we are also planning to float a $1.5 billion bond, or that is about 1.8% of our GDP in another sovereign bond, even as we have to service 4.5% of GDP in external debt servicing. So would that 1.8% of GDP in another sovereign bond just be used every year to service the debt? What would be the benefit of going back to the markets would be a question. And I think, as Brad mentioned, these macro-linked bonds, they're also on the basis of Sri Lanka's GDP measured in dollars. So if the rupee appreciates, then suddenly our GDP looks much higher. We're going to have to pay the bondholders much more. But then that would actually work against us bringing in export earnings, because now our currency would have appreciated, so our exports might actually drop. So some of these issues, I think Brad has also articulated in his blog post that just has been shared in chat, but we'll come back to that. So, the concern is that we might be going into very difficult times 5 years from now, or almost get caught in a. Before that, I want to bring in Malina into the discussion. Malina, if you can say a little bit about, how sustainable is this IMF agreement, right? I mean, this IMF agreement is supposed to finally get Sri Lanka out of this mess, but will that be the case, or could another shock push us back into a crisis? And then again, this idea of renegotiating an IMF agreement, this is being discussed currently in the election campaigns as well, that both the front runners in the election have said that they would want to renegotiate the IMF agreement, though they haven't specified how. Has this happened in other countries, or is it possible? Your thoughts on that. And then finally, I think, as words going back to the capital markets and borrowing more, is that the kind of strategy that Sri Lanka should pursue in terms of its economic development? So, Malina, if you could speak for about 10 minutes, and then we'll go into sort of a discussion after that. Thank you.
Yes, thanks a lot, and thanks also for inviting me to this webinar. I would like to invite us to broaden the perspective a little bit, and to move maybe a little bit away from this technical analysis, which Brad brilliantly outlined for us, and which is, of course, really needed. But let me state with the very basic observation that the IMF debt sustainability analysis is not a hard science, and it's not based on hard science. There's a saying that doing debt sustainability analysis is rather an art than in science, and maybe we should kind of add that it's also an interest-driven art. But just to start with, let's see, only because there are very sophisticated calculations and very complex models and very models that makes it very difficult also to engage for lots of people in these discussions. It does not say that the parameters and benchmarks derived from those calculations are politically sensible. And I think in the case of Sri Lanka, coming to your first question, whether this IMF debt sustainability analysis appears to be sustainable, I think it's pretty obvious, and we do have to state it in this obvious way, that it does not seem to be politically sensitive. And especially the first and maybe most important point for me is, from a social perspective, it does not seem to be sustainable. Like we heard before, and this is really a huge problem, that what was saying that there might be, or that there's a big chance that Sri Lanka might get in a second default in 5 years from now, which is like economically in a long-term perspective not sustainable. But it would even be maybe not that a big problem if we would have a good way in these next 5 years. But I think from a social perspective, you see that also now, also in the next year, also in the next 5 years, we do see huge social suffering in Sri Lanka, which is also bind to the IMF benchmarks and parameters and to the demands outlined in the IMF program. So this is, for me, this is the first very important point to keep in mind, that we see this program not being socially responsible, not being socially sustainable. And then second, of course, there's a point that what already outlined in detail, that we do have huge concerns whether the program is economically, in a long-term perspective, sustainable. I think I do not have to repeat all the arguments but already made in this regard, but just to compare it, but already compared it to other cases which are currently restructured, like Zambia, like Ghana. But also if we look at it a little bit historically, we had the 1980s and 1990s, in which creditor and especially debtor states had to learn by really kind of the hard way that too little debt cancellation will be very costly in the end, also economically costly. And back then, we ended up with, finally, after almost 20 years of negotiation and of protecting and of suffering, we ended up with debt cancellations that limited external debt payments to 15% of state revenues. And now Sri Lanka is expected to pay like something like the double that amount. So there's just basically no reason to believe that this could be sustainable, not politically sustainable, not socially sustainable, and also not economically in a long-term perspective sustainable. So then there was the second question. Okay, if we do this analysis and see that the current path is not sustainable, how can we move? How can we move forward? How can Sri Lanka move forward? And to your question, I think it's very important to keep in mind that theoretically there's always the way to renegotiate. If we look at the case of Argentina in 2020, Argentina did basically simply walk out of the IMF agreement. And nevertheless, Argentina managed to restructure foreign bondholders' debt. Of course, in the first case, bondholders said they do not like that. They do not like Argentina walking out of the IMF program. They wanted Argentina to stay within the program. But this is not like negotiations, is not bondholders or creditors in general raise their hand and say what they want and what they don't want, and then it's done in the way, exactly in the way they want it to be done. But then if it would be this way, like negotiations would be a misnomer, right? It often appears to be this way, but then it's rather a dictate from the creditors. But I do truly believe that there is space for true negotiations, and true negotiations means that creditors and also bondholders sometimes have to accept things that they don't, and for sure they would not like Sri Lanka to renegotiate now. But I think simple from the analysis, we see that renegotiation is needed, and to a limited extent. IMF program is kind of constantly renegotiated, only in a limited extent, but with every review, there's a possibility to renegotiate. And yeah, I think it's important for Sri Lanka to use this opportunity and to stand up for its own interest, to put the interest of its population into the discussions. And when doing this, I think it's most important to do it as transparently and as publicly as possible, because closed door negotiations are always kind of more favoring creditors' interests. And then we could say much more on this, but I think we also want to have some time for questions. So let me briefly come to your last questions. The point of regaining capital market access, and generally looking at bondholders' situation or the bondholders' deal at the moment. So I think what is very important to keep in mind is that also the deal which is proposed at the moment, which is on the table from bondholders, would lead to a situation where bondholders will still make huge profit. They would make a little bit less profit than before, but they would still make huge profit. Like long-term bondholders would make bigger profits than they would have made with investing in, for example, US or in German treasury bonds. And this is the case, even though they charged in advance, they charged very high interest rates to protect themselves against the risk of default. And now the risk of default materialized, which is the only reason why you would maybe accept high interests in the first place. But nevertheless, bondholders still make huge profits. I said, like, long-term bondholders will make still larger profits than if they had invested in German treasury bonds. But bondholders who bought the bonds on the secondary market in times of crisis, they would make more than 20% of annualized interest rates, which is really a lot. And looking at the suffering of the people in Sri Lanka, I think it's ridiculous and it's not acceptable. So coming to the question of regaining market access, I think it's not like, it should not be a kind of very ideological decision going to the market or not going to the market. It should be in every single case a very well thought and well questioned decision. And you just need to take into account or really questionable analyze what kind of projects, what kind of development projects could be financed by market by credits from the capital market, because usually those credits come with high interest, and Sri Lanka had to pay high interests even in the last 10 years, like even in times where global liquidity was where global interest rates were very low. Now global interest rates are much higher, and the debt stock of Sri Lanka is much higher. So I would just say I would be careful and really look properly at what interest rates is it useful to take on loans from the capital market again. And final thoughts on this regaining capital market. I think even if this is a long-term perspective that Sri Lanka wants to go, the best thing to do today is to demand deep cancellations from the current bondholders, because only if the debt stock is reduced in a substantive way, there's at all the possibility that future creditors would be willing to lend at Sri Lanka at reasonable interest rates. Yeah, let me stop here so that we have some time for questions and discussion. But thanks.
Thank you, Malina. So I think there are 4 questions in the Q&A box. If others want to put their questions into the Q&A box or if you would prefer to raise your hand, but if you can be very brief with your question. Maybe I'll just quickly read out some of the questions in the Q&A box. So I'm just going to summarize them. And then maybe Brad and Malina could respond. I mean, what is your impression? Has the country's situation been improving so far in the last, say, almost 16 months that Sri Lanka is in the IMF program? Or is it still, you know, are there dangers of derailing? I think some of this already came up. And I think Malina also addressed this, but the question of interest rates, right? At what interest cost is this debt going to be serviced, and is that sustainable given the kind of situation Sri Lanka is in? And maybe I'll add to that. I mean, as Brad mentioned, Sri Lanka is being considered as a market access country like any Western country, where interest rates sometimes are, you know, go down as close to zero or much lower than what we have in Sri Lanka. So when we have such high levels of debt, is that sustainable? And a question about whether this market access MLBs, the macro-linked bonds for market access countries, is Sri Lanka the first case? I wasn't clear, Brad. I thought you mentioned that Sri Lanka was the first case. Is that so? Has there been, is there any experience of how this actually works out in reality, or we're going through this for the first time? And why is there so much lower net present value reduction in the case of Sri Lanka, say, compared to Ghana, is another question. And then in terms of, what really happens in the bond markets, I think very few of us really understand what happens in the bond markets. But the last time I also checked, I think the average Sri Lankan bond is now trading again at like 48 cents on the dollar. So when a new financial institution comes and purchases that bond, when they actually mature, they're going to make a huge profit, right? So why the NLDs and so on in that kind of a context? So these are some of the questions that have come up. Now, there's one more, or a couple more. Brad, there's a question about illicit financial flows and whether that would have an impact on Sri Lanka's capacity to repay, or the kind of capital flight that can also have a bearing on debt sustainability. So, and then finally, I think the question, and maybe I'll stop there, and you can choose some of these questions, maybe not all of them. At the end of the program and onwards, from 2027, 2028 onwards, this 1.8% of GDP worth of sovereign bonds. So the first one will be $1.5 billion sovereign bond. And then after that, little larger than that. How does that fit in with debt servicing? Because they are going to be continuing to accumulate larger and larger amounts of debt. So maybe, Brad, you could start with these, and then hopefully we'll have a second round. I might also have a couple questions.
Sure. So I do think that the precise structure of Sri Lanka's macro-linked bond, and in particular the linkage to dollar GDP, is an innovation. It is unique to Sri Lanka. You can certainly see echoes of it in the Zambia restructuring, which had A bond, B bond, where the B bond was in some sense a macro-linked bond, but it was tied to the IMF's assessment of debt servicing capacity, not tied to GDP. I think there will be some elements of the macro-linked bond proposal in Ukraine's restructuring. I think what's common across all three is the idea that a country's debt service is not fixed at the time it does the deal. The country's debt service is a deal. The deal fixes the country's debt service based on agreed variables at the time the country leaves the IMF program. So it's a way of sorting out disagreements about how well a country will perform during the IMF program. These structures all have the downside of effectively penalizing a country for doing well during its IMF program. If Zambia does well in its IMF program, if its debt servicing capacity is upgraded, its bonds become much more onerous, and it faces a wall of maturities. If Sri Lanka does well, if dollar GDP is above 100, these bonds become much more expensive, and Sri Lanka has to pay a lot more debt service. So in that sense, countries are penalized for doing well, and the bondholders, the existing bondholders, sweep up the gains of a country's performance during the program. I think they sweep up too much of the gains. That's sort of my criticism. I agree that one of the weaknesses of both the IMF program and of the restructuring is that it is predicated on Sri Lanka's ability to go back to the international bond market for 1.5 billion, let's say, roughly a year, every year after 2027 or 2028. It would be doing so at very high levels of debt, at very high levels of external debt. And there's a very high risk, if you look around and look at the rate Kenya paid, that Sri Lanka might only be able to raise money at that point in time by paying 10% or more in a coupon. So Sri Lanka's debt service would go up. Now, most of that bond issuance is just to repay the maturing components of the existing bonds. Only a part of that is to finance the budget deficit. But I would personally have preferred there to be a lot less debt service during the period between 29 and 2032, when Sri Lanka's debt to GDP is so elevated. It is obviously a major risk that Sri Lanka will have to pay even more on its bonds over that period of time. And that's why I think there is a reasonable risk that Sri Lanka's current program doesn't lay the basis or doesn't create a strong financial foundation. One simple test I like to use in a debt restructuring is the following. Is the coupon payment on the new bond, the bond that emerges from the restructuring, coupon is what bond guys call interest, is it higher or is it lower in aggregate than the coupon on the old bond? Sri Lanka's old bonds had a face value of $12.5 billion, a coupon that was a little bit above 6%. So you're looking at, let's say, 700 billion, little less, 700 million in annual debt service. If the macro-linked bonds are reset at the $100 billion threshold, there will be 10.65 billion of bonds and 8%, or almost 900 million a year in debt service. So in that context, the amount of debt service, interest, that is, not full debt service, that Sri Lanka pays goes up, it doesn't go down. Now, my question to the bondholders is, if Sri Lanka couldn't pay those bonds 2 years ago, what makes you think Sri Lanka will be in a position to pay even more in 3 years? What's going to be so much better about Sri Lanka's economy, its external payment capacity, that warrants an increase in the underlying coupon? And that coupon could go up if Sri Lanka has to refinance some of the maturing principal at 10%. To me, that's the core question about this restructuring. Is Sri Lanka the kind of country that can come out of a restructuring with a bigger debt burden than it had going in? Or is Sri Lanka, because of its history of not having reserves, having difficulty collecting revenue, having a relatively modest export base, and a lot of exposure to commodity price shocks and oil price shocks, the kind of country that needed to have a lower level of debt service? So to me, that is actually a vital issue. And that highlights why I, along with the aggregate amount of debt service relative to the revenue base, why I have very fundamental concerns about this deal.
Malina, you want to come in on a couple of those questions?
Yeah, I can come on to some of them at least. There was a question on whether we do believe that Sri Lanka improved, or whether the Sri Lankan situation improved since Sri Lanka started the IMF program. And I guess many of you in the call are much better experts on the concrete Sri Lankan situation, on the social situation in Sri Lanka. But as it appears to me from the outside, it's first, I do not see like social improvement. I do rather see social suffering during the last years, which is increasing, inequality which is increasing. And this is the first like really problematic point. And then on the economic term, we spoke about it before, and Brett spoke about it, about the chance of defaulting again in 2028. And I would say if there's a huge risk that, and if many people, if it's not just me and Brett who think that this could be possible, and I think there are many people out there who think that this is possible, even in the IMF analysis itself, it's written that they do not believe that this debt restructuring is going to restore sustainable levels. So if we do have this risk, and if there's this risk of defaulting again on some years, this would also hamper economic development until then. So it's not to be expected that much that the economy will develop very good, very healthy until then, if there's always this risk, and this risk, people see this risk of macroeconomic instability. So yeah, from my perspective, I do not see many improvements yet, or many improvements to come without renegotiating the IMF debt sustainability analysis. And then there was also the question on the austerity measures and on the social protection and the social suffering, how much is directly linked to the debt restructuring and to the IMF debt sustainability analysis. And I mean, in general, without going very much into detail, into the technical details, the demands put forward from the IMF are very broad and in a very general manner, and not dictating in detail on how to spend social protection and so on. But really the direct link exists because the demand to cancel debt is so limited. And it's just this macroeconomic framework, let's say, if there's so little scope for political action, for real meaningful political action, because kind of 30% is going to external debt service, of course, then there's also very limited action for social policies and social spending, etc., in the country. And this is also something that I really feel also to see, and I'm really excited and interested to see with the next election. But I think one really crucial point is that the next government has political space for meaningful political action, for doing policies that do actually change the living standards of the people. And I fear if they would not do this, and again, you are more the experts than I am, but I would fear, because we saw it in other cases as well, that political struggles and that ethnic and cultural conflicts will gain again also the upper hand. So then there was also the question on why the IMF is allowing this. I would say I started in the beginning, it's kind of, doing that sustainability analysis is kind of interest-driven art, and it always depends on who is best prepared to bring in their interests. And of course, with the IMF, we do have the problem of different voting shares of different countries, of huge voting share of the US, and of course also of huge lobbying from the US financial sector. For sure, we should not be blind about this. But then we do have, and I said this before, I'm convinced that we do have the negotiation space, and therefore we need Sri Lanka and the Sri Lankan government to really stand up for their own interests, to really put the interest of the population first, and to make all these negotiations a bit more transparent, a bit more public, to bring those negotiations into the public. Because, yeah, as I said before, behind closed doors, it's always kind of capital interests which have the upper hand, I would say.
Okay, thank you. So maybe just some final thoughts, both from Brad and Malina, and I'll draw on the one last question, and I have a question. So I think what a lot of Sri Lankans are grappling with is this question that we had a government that did not have much legitimacy. We had a president who was not elected by the people the last 2 years, and he was also the finance minister. So there is a concern that, you know, a lot of things were rushed through without properly even negotiating with the IMF, and the terms are very unfavorable to Sri Lanka, right? With the current IMF program, the existing DSA. And the worry is that while this is the first time Sri Lanka has defaulted on its debt, that this could become a cycle, right? That we might be going to this vicious cycle of repeated defaults that we've seen happen to many countries, even though Sri Lanka has never defaulted before, and then that would really undermine our socioeconomic development. So if that is the case, you know, should Sri Lanka maybe, if things become clear that the situation is deteriorating so rapidly, that we try to, you know, ask the IMF to renegotiate in terms of also the parameters of the IMF agreement, a new DSA. Has that happened, and is that a prospect? Two, if you are facing another default, you know, does it make sense, because the bulk of our debt is to the bondholders, that we default only on the debt of the bondholders, and we keep keep servicing the bilateral debt? So if we face another crisis like this. So those are just some broad questions, and maybe Brad, and then Malina, and then after your, and anything else that you would like to say in closing, and then we could bring the webinar to an end. Thank you.
Well, there's a lot of important questions there. As a technical matter, I think it's hard to evaluate whether Sri Lanka should differentiate in a future debt servicing crunch between bondholders and bilateral creditors, Japan, India, and China being the most important of them, because we don't actually know the terms, the actual financial terms of the restructuring of the bilateral debts. That has been kept secret. We can guess. The IMF has said that the terms are consistent with the debt servicing agreement, but we don't actually know the details. In general, I think the bondholders would feel that if they were not being paid and China was being paid, or if they weren't being paid and India was being paid, that there was a differential in treatment that would create difficulties going forward. So my general belief is that in most circumstances, if you end up on default on the external bonds, you're going to end up in a situation where almost all the external debt needs to be renegotiated and reconsidered, because it was all part of an agreement based on this current debt sustainability analysis that allows everyone, not just the private bondholders, to get a relatively generous deal. I guess the second point I would make is that, you know, on some measures, Sri Lanka's economy has been performing pretty well. recently. The exchange rate has appreciated, GDP is growing. The GDP, dollar GDP is above what the IMF forecast, which makes it a bit more challenging to start over. Not impossible, but a little bit more challenging to start over. But this outperformance has come when Sri Lanka has been paying nothing to any of its external creditors. And what we don't know is whether that performance can continue when Sri Lanka starts paying a little bit, as it will if these deals are completed. And we certainly don't know if that performance can continue once Sri Lanka has to pay a lot on its external debt when the IMF program ends. My concern has always been that economic performance during the program period, when debt payments are quite low, would not accurately forecast performance outside the program payment period when payments go way up and Sri Lanka faces a very real risk of redefault. I personally think it would be eminently reasonable, given the exceptionally high risk that this particular deal creates of a default in 29, 30, 31, 32, for a new government to come in and seek a set of terms consistent with this debt sustainability framework or with a new one, but with an added criteria imposed by the government that seek to reduce that risk. If the goal of Sri Lanka is to be one and done, to not be in a position of repeat defaults, you need restructuring terms that create that possibility. And I don't think those restructuring terms are what is going to emerge from the current restructuring. To be clear, many governments, particularly new governments, do renegotiate with the IMF. You can renegotiate how much you're willing to do, your fiscal adjustment, but the debt sustainability analysis is only partially a function of what you are willing to do. It is also a function of the IMF's evaluation of your structural criteria. And unless the IMF reevaluates those structural criteria, the new debt service sustainability analysis may look shockingly like the current one. If I were the Sri Lankan government, though, I would insist that a future debt sustainability analysis cover variables that were omitted in the past debt sustainability analysis, cover variables like interest payments relative to revenue, debt service relative to revenue, the total stock of external debt, and using those new criteria, put an overlay that is a bit more constraining on the outcomes. But, look, that is one of the most consequential decisions a government can make. There is effectively a deal. I mean, the IMF and the Paris Club creditors haven't signed off on the macro linkage of the new bonds, but they've signed off on the base bond. So Sri Lanka would be effectively tearing up a deal that its current government has negotiated and gotten agreement with its creditors and saying, we want a better deal. Some creditors would view that as akin to a default. So it is a consequential decision, very, very consequential decision. My last point is that I don't think the IMF should have put Sri Lanka in this position. I don't think the IMF should have ever put forward a debt sustainability analysis that allowed such a high level of debt to GDP at the end of the program. I don't think the IMF should ever have put forward a debt sustainability analysis that suggested Sri Lanka, with much less revenue, and that's the one place where the current program is not performing well, revenue to GDP in the last staff review is still close to 10%. A lot of adjustments still there to happen, that a country with that little revenue shouldn't be expected to pay much more debt service than comparable countries. So I think there's some real responsibility that goes on the shoulders of the IMF, but that is not to downplay the consequences of trying to undo the program and undo the debt sustainability analysis and undo the debt restructuring. Changing that is a hard haul, one that would require real political consensus inside Sri Lanka, because it would put Sri Lanka at odds with much of the international community for a while.
Thank you, Brad. Malina, you want to add something?
Yeah, maybe I can exactly add where Brad stopped. I do think that renegotiating the IMF program is key. However, I also think it's about thoughts should be spent on how sequencing looks like. I do not think that the new Sri Lankan government, however it will look like, should absolutely first focus on renegotiating the IMF program, and then until it did not manage to renegotiate it, do everything to stick to every demand like in the current program. First, you will not have big negotiation power, let's say, in the negotiations with the IMF if you stick like to every single parameter which is demanded by the IMF until now. I said this before in the reviews, there are constantly some renegotiating things, and mostly they kind of react to facts that were already kind of created on the ground. So I think, yes, there should be renegotiating, but already before Sri Lankan and the new Sri Lankan government should for sure focus on more sustainable social policies, social fiscal spending, and so on. And also before, I guess, or parallel, negotiations with bondholders have to be more demanding from the Sri Lankan side, I guess. And then regarding the renegotiations with the IMF on how to do it, I guess what is really key, and that's kind of echoing a little bit what said before, is to put up and to bring in your own analysis of the situations. And therefore, there are, I think, many experts out there, as and here we'll have many experts within the country itself, but there are also many experts out there, like Brett, but like other experts that were already in the country in June, who did this before and who you could kind of consult on which parameters to include. But I think it's key to enter in those negotiations with putting up your own analysis on the debt sustainability situations. And in there, I think it needs to be focused much more on human rights and on the guaranteeing human rights in Sri Lanka and for Sri Lankan populations than it is currently the case.
Thank you, Malina. Thank you, Brad and Malina. I think we've learned a lot from this session. You know, the kind of fundamental problems with the ongoing IMF program and the debt sustainability analysis. At the same time, the huge challenges for Sri Lanka going forward, the danger of another default or the program being derailed. And then the kind of political will, as Brad mentioned, the political will or the political consensus that would be necessary if a country like Sri Lanka is to renegotiate the IMF agreement or the DSA or the debt restructuring process. And we are just about to have elections and then followed by parliamentary elections, and it's to be seen, first of all, what kind of political consensus and mandate the new government would have. So I think this has been a really enlightening session. Thank you very much, Brad, for your time and for both your writing and analysis on Sri Lanka and for sharing it with us. And thank you also, Malina, for your continued engagement on Sri Lanka. Thank you, everyone, for participating, and look forward to more discussions. Thank you, everyone, and goodbye.